Hello, today on session 6, I will talk about bonds and their valuation. On our previous sessions, we said that companies may raise funds through two main sources. One is from shareholders' investment, and the second is borrowing from lenders. So borrowing may be in two forms. One is famous from borrowing from financial institutions, banks and others. And the second one is borrowing through issuing bonds. Today, we'll talk about bonds and their valuation. In general, a corporate bond or government bond is borrowing from financial markets or individual investors through issuing an agreement and a legal agreement that company promises to pay back periodic payments and principal amount at the end. So, we can say that bond is a legally binding agreement between a borrower and a lender that specifies the face value, coupon rate, coupon payment, and maturity date of the bond. It means that as an investor, if we go to a financial institution, buy a bond, we will see indenture, that is instruction of a bond, and it will say us about coupon payments, that's periodic payment of that bond, face value, that's par value, payment schedule, how frequently it will pay out that coupons, it may be semi-annual, annually, monthly, and others, and the maturity date, until what date that bond is valid. And the bond has yield to maturity, that is required market interest rate on the bond, that is, in other words, we'll talk about this indicator in details. In general, this is how much lender requires on this bond. We shouldn't confuse the coupon rate with the required market interest rate. Coupon rate is periodic payment rate that is calculated based on the face value. In corporate bonds, in general, face value is $1,000 or in the currency. For example, if coupon rate is 6%, it means that periodic payment of that bond is 6% of face value, 1,000, that's $60. In general, bonds have maturity of 30 years, but that's, as I said, in its general, that there are some bonds with longer than these dates and shorter than that date. For example, there are 100-year coupons issued by Volkswagen, Nestle, Walt Disney, and other companies. To evaluate a bond, we find present value of cash flows generated through holding this bond. Our general principle is that value of price of any financial asset is present value of future cash flows. If you buy, as an investor, if you buy a bond, you get coupon payments and the principal, that's face value at the end of the period, at the maturity date. So, logic is to find present value or price of this bond, we discount back coupon payments at required rate and face value. So let's look at a sample bond. That company has issued a 10-year bond with an 8% annual coupon. Cash flows from the bond will be paid as follows. Cash flows, that is 8% rate results in $80 coupon payments. That's 8% of face value, 1,000. So in year one, as an investor, we get $80. In year two, $80, until the 10th year, we get $80 per period. Here is per year. And at the end of period, we get face value, 1,000. So value of price of this bond is present value of all these cash flows at required market rate, yield to maturity. And as we said in our present time value of money session, this 80 stream is an annuity. So finding a present value of these annuities plus face value of this present value of this lump sum, 1,000, we get price of this bond. Or if we generalize this approach as a formula, this is 80 present value annuity factor plus face value discounted as a lump sum at market rate for the time to maturity. Frequency of coupon payments, bond terms, bond agreement that dictate the frequency of coupon payments. So everything about bonds is written on bond agreement. Coupon rate is expressed in annual terms. Rate, coupon payments in general, it's annual terms, but if the payment schedule is different than annual, we arrange this payment due to that frequency. For example, in US, in general, corporate bonds are paid in semi-annual periods. We need to divide coupon payment on this rate by 2. Dividing the annual coupon payment by the number of compounding periods per year to arrive at the value of each coupon payment, as I said in semi-annual payments. Dividing the annual required rate of return, yield to maturity, by the number of compounding periods per year to arrive at the desired periodic yield, and multiplying the remaining years of the bond's life by the number of compounding periods per year to arrive at the remaining number of coupon payments. Making these adjustments, we come to we convert these numbers into our formula here. We put these numbers in our formula and find price of bond. Consider a US government bond with a 3 to 8% coupon that expires in December 2020. The par value of the bond is $1,000. Coupon payments are made semi-annually, that is June 30th and December 31st for this particular bond. Since the coupon rate is 3 to 8%, the payment is 31.8675. As I said in our time value of money topic, the best way is to show cash flows on timeline. Here we are on time 0 and the rate is 638, that's coupon, and the period is starting from 1st of January 16 until end of December 20th. That is 5 years. 5 years. And the required rate is, let's say, that is 6%. So what's the present? And the coupon is paid semi-annually. So what's the price of this bond? Price of this bond is present value of future cash flows. Here, starting from this date, we have 5 years from, as I said, from beginning of 2016 until the end of 2020. So we have 5 years. Since the coupon is paid semi-annually, we have 10 periods. We have 2 semi-annual periods in a year, so we have 10 semi-annual periods in 5 years. 1, 2, blah, 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 10 years. And we need to find coupon payments, periodic semi-annual coupon payments. Our rate is 6.3 to 8. So this is, as I said, all rates are expressed in annual terms, annual periods. We need to divide this, convert this into semi-annual periods by dividing these to 2. So we get coupon rate, periodic coupon rate as 31,875. So this is semi-annual coupon rate. So semi-annual coupon payment will be, that's the rate of face value, 1,000. Here we get $31.875, 31.8, I rounded to 8, blah, 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 $31.8, and at the end we'll get plus $1,000. So finding present value of all these cash flows gives us price of this bond. And the rate is 6%. Again, this is expressed per year. payments are in semi-annual periods, we divide this by 2, get periodic yield to maturity. Price of this bond is 31.8 divided by 1.03 plus 31.8 divided by 1.03%, blah 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 blah, 31.8 divided by to the power of 10 plus face value at the end. So find the present value of this cash flow to get price of this bond. Here we see until this term, this is annuity. We find present value annuity, and this is lump sum. We put cash flows here, find present value of these cash flows, and get the price of this bond. Again, we shouldn't confuse coupon yield with the yield to maturity market rate. These are different rates. Coupon rate is how much company issuer will pay per period. Yield to maturity or market rate is how much investor requires, simply. So these are two different terms. And let's say in our same example, required rate is 5%. That is per year, of course. As you see, market rate was 6.3 to 8. The required rate is 5%. This is less than coupon rate. So what will be the bond price? We discount this rate by 2.5%, half of this percent, and find present value, calculate present value of annuity plus present value of lump sum face value. We get $1,060.17. Price of this bond is $1,060.17 at 5% market rate. As we see, this $1,060 is higher than face value. We call this type of bonds premium bonds. You see, it's higher than face value. These are premium bonds. That is, very simply, investor requires 5%, but the company gives 6.3 to 8%, higher than what investor requires. That's why it's valued at higher than face value. That's why we call it premium bonds. And discount bonds, let's assume vice versa. Required rate is 11%. That's higher than 6.3 to 8. It means that investor requires 11%, but company gives about 6%. So what will happen to bond price? We again have coupon payments plus face value and discount all these cash flows at half of 11%, again because of semi-annual payments. Half of 11%, we get 825.69. You see, it's less than face value. So we call this type of bond discount bonds. When required rate is higher than coupon rate, bond price goes below face value. We call this type of bonds discount bonds. And again, logic is simple. As I said, investor requires higher than coupon rate, and they desire to less than face value. And we can say that bond price and required rate yield to maturity is inversely related. When market rate goes up, bond price will go down. Here we can see what I said graphically. When the yield to maturity, that's required rate, is less than coupon, the bond trades at premium. In our first example, that was 5% market yield, but the bond rate is about 6%. Here, during this term, you see it's higher than 1,000. Bond price is higher than 1,000. When it comes to market rate, coupon rate, when market rate equals to, that's yield to maturity equals to coupon rate, bond sells at face value, 1,000. You can calculate for any coupon payments, any type of bonds, equate coupon rate with the market rate, you will get 1,000. When yield to maturity higher than coupon rate, here at these periods, the bond trades at discount. You see the price goes down, goes below 1,000. And again, here you see bond price and yield to maturity is inversely related again, and the graph is like convex. We need to we should talk about some bond concepts. Bond prices and market interest rates move in opposite directions, inversely related. When coupon rate equals to market rate, yield to maturity price equals to par value. Again, we sell the bond sales at face value, par value. When coupon rate is higher than yield to maturity, price becomes higher than face value. We call these premium bonds. When coupon rate is less than yield to maturity, price goes below par value, face value. We call this type of bonds discount bonds. As I said, bonds are long-term investments. As an investor, when you buy a bond, you may want to hold it for 30 years and even go beyond, some bonds go beyond that date with higher maturities. So then, but through these 30 years, market rate, interest rate will change. So 30 years is a long period. Market rate, interest rate, general market conditions, economic conditions may dictate some new change. So the rate, interest rate will change through this period. As I said, when interest rate increases, bond price will decrease. So as an investor, you have concerns about your bond investment, because if interest rate increase, your bond will be less valuable. That's why we call there's interest rate risk in investing bonds. We have price risk and reinvestment risk. Price risk is change in price due to change in interest rates. Long-term bonds have more price risk than short-term bonds. So it's logical that long-term bonds are more sensitive to interest rate change than short-term bonds. That's very logical. Low coupon rate bonds have more price risk than high coupon rate bonds. That's because low coupon rate bonds price mainly comes from present value, face value, but higher rate coupons price mainly comes from present value of coupon payments. Reinvestment rate risk in long term, of course, we assume that investor will reinvest coupon payments again. So there is uncertainty concerning rates at which cash flows can be reinvested. So through long periods, if interest rate declines, so reinvestment opportunity declines then. Short-term bonds have more reinvestment rate risk than long-term bonds. High coupon rate bonds have more reinvestment rate risk than low coupon rate bonds. Here let's look at maturity and bond price volatility. As we said that long-term bonds have a higher interest rate risk, are very sensitive to change in interest rates than short-term bonds. Here we see long maturity bond, short maturity bond. As we see that long-term bond graph is steeper than short-term bonds. This steeper means a small change in discount rate will yield higher change in bond value. But we see that in short-term maturity bond, it's less steeper, so change in discount rate will have less change in bond price. Again we see low coupon bond and high coupon bonds. We see that low coupon bonds graph is steeper than high coupon bonds. Again, this is because of low coupon bonds price mainly comes from present value of face value, that's 1,000, but high coupon bonds price mainly is derivated from present value of coupon payments. So again, steeper graph means small change in discount rate will yield higher change in bond value. So we talked about yield to maturity of a bond, that is required rate on bond, how much rate an investor requires on investing this bond. Yield to maturity is, in other words, is if an investor buys this bond and holds until maturity, how much average annual return will that investor get? So in other words, yield to maturity is required rate. Again, let's say we have 1,000 par value bond at coupon rate of 8% and maturity of 10 years. That says at price or value of bond, let's say $938. That's price. So what's the yield to maturity of this bond? If this bond sells at $938 in the market, what's required rate on this bond? In other words, what's the yield to maturity on this bond? If we apply our previous formula, value of a bond is 938, that equals to present value of, let's say this is annual bond for simplicity, present value of all these cash flows. 8% coupon rate yields an $80 of coupon, $80. We discount at 1 plus yield to maturity, plus again $80, we discount at 1 plus yield to maturity, square, plus blah blah blah, plus $1,080, 1 plus yield to maturity, power of 10. So yield to maturity is this number. In our previous examples, we had rate of 5%, 11%. Here we are not given, we need to find this rate. Again, this rate is how much investor will get annual return if he or she buys this bond at this price, $938 with these indicators, 8% coupon rate and for 10 years. How much annual return as a percentage will this investor get? So mathematically you see it's difficult to calculate. Until this $80, this is annuity, but we have lump sum here. Thus, we cannot easily find this yield to maturity, but thanks to Microsoft Excel or financial calculators, we have easily find this rate. If you have financial calculator and NPV, PMT, and FV, remember the sign conversion, and you get the yield to maturity. But in general, finding the yield to maturity requires trial and error. If you do not have any financial calculator, it is similar to process for finding the RV than in UT. Also, we have concepts current yield, and current yield is different than yield to maturity. I said that yield to maturity is average annual return if an investor holds that bond until maturity. It requires holding that bond until maturity. So average return per these years is yield to maturity. But if an investor doesn't want to hold this bond until maturity, so if they hold for 1 year, what they get is current yield. It's calculated as annual coupon divided by price. That's very easy. Yield to maturity is current yield plus capital gains yield. Because we have yield from face value, that's capital gains yield. Example, 10% coupon bond with semi-annual coupons face value of 1,000, 20 years to maturity, and the price is $1,198.93. Current yield here is coupon payment, that's 10% of face value, divided by price, that is 8.35%. Price in 1 year, assuming no change in yield to maturity, that's calculating price with same yield to maturity, but with the period of 19 years. That in 1 year means 1 year passed, so remaining maturity is 19 years. Price will be $1,193. So capital gains yield is, that's a simple return calculation, 1,193.63 minus previous period, 1,197.93 divided by previous period. That's minus 3.85%. So yield to maturity will be here, current yield, this person 8.35% plus minus 0.35%, and this 8%, which is the same yield to maturity computed earlier. We have some bond pricing theorems that's applying some mathematical rules. We get these arguments. Bonds of similar risk and maturity will be priced to yield about the same return regardless of the coupon rate. If you know the price of one bond, you can estimate the yield to maturity and use that to find the price of the second bond with the same risk level. This is a useful concept that can be transferred to valuing assets other than bonds. Same principle can be applied to other financial assets. Some ideas about bond features. There are two kinds of securities issued by corporations. As we said, equity, that's ownership interest, and debt, short or long-term borrowing. Bonds are debt instruments that's not the ownership interest. Creditors do not have voting rights. They have priority as they get their interest coupon payments exactly. Interest is considered a cost of doing business and it's tax deductible. That's why companies go to debt financing and prefer it to equity financing. Creditors have legal recourse of interest or principal payments are missed. Excess debt can lead to financial distress and bankruptcy, where managers consider these very strictly. Equity, we know ownership interest. If you buy an equity share of a company, you have ownership in company. Common stockholders vote for the board of directors and other issues. Dividends are not considered a cost of doing business and are not tax deductible. Dividends are not a liability of the firm, and stockholders have no legal recourse if dividends are not paid. So the board of directors decide to pay out dividends or not. It is up to general condition of company, that's future plans of company. Company may retain that cash in company for future projects and others. And all equity firm cannot go bankrupt. Bond indenture, we said that that's contract between the company and the bondholders that shows the basic terms of the bonds. These are coupon rate, period, payment period, schedule, and maturity and other terms. Total amount of bonds issued. Description of property used as security if applicable, if there is any sinking fund provisions, call provisions, details of protective covenants. So all these conditions, terms are clearly expressed in bond indenture. Bond indenture is an agreement, it's a document, shows everything to investor, informs investor about all details of that bond. We have sample bond features here. Here's a Walt Disney Company bond. So here you see amount of issue is $1 billion, and also it has explanation. The company issued $1 billion worth of bonds. Date of issue when it was issued, it was January 8th of 2016, and the maturity when they will expire, the last face value payment will be on 13th of February 2026. Face value is 2,000. We said 1,000 is the general, but here it's up to companies, they may change it. They issued at 2,000 face value. Annual coupon is 3%, 3% face value. That's $60 per period. That's annual. Offer price is 99.600. Offer price will be 99.6% of the face value. It means that it's priced at $1,992 per bond. Coupon payments, payment dates are it's a semi-annual coupon. That's 13th of February and 13th of August. And at each period, $30 of coupons will be paid. Security, no, are not secured by specific asset. That's not asset backed. Sinking fund, no, the bonds have no sinking funds. That means it's against investors. Call provision at any time. The bonds do not have a deferred call. Call price, treasury rate plus 0.15%. It has a make whole call price. It means that company may call back its bonds at any time at this rate. And rating, Moody's A2, Fitch A. Bonds have a medium quality credit rating. So investor gets all this information from bond indenture and decides to invest or not. That's to buy or not. Also, some words about bond classifications. Bonds may be registered or bearer forms, that is open to everyone, or that's specially designed for bearer. It has some security features. It may have collateral secured by financial securities or not. So it's it may be asset backed or not. Mortgage secured by real property, normally land or buildings. Mortgage bonds are of this type. And debentures, these are unsecured bonds. Notes, unsecured debt with original maturity less than 10 years. These are called notes. And also they have seniority features. Bonds are prioritized or listed due to their seniority. That's if company goes bankrupt, which bonds will pay first. They are listed. Higher, the first one is more senior, it goes down to less senior bonds. And some words about bond ratings. It shows investment quality. Higher grade bonds, we have we have rating companies, Moody's, S&P, and others. Moody's AAA and S&P's AAA. These are high grade bonds. Capacity, they have capacity to pay is extremely strong. Moody's AA and S&P's AA capacity to pay is very strong. These are high-grade bonds. Moody's A and S&P's A, these are medium-grade bonds. Capacity to pay is strong, but more susceptible to change in circumstances that you have doubts. Due to circumstances, it may defer, it may delay some payments. Moody's B, AA, and S&P BBB, again, medium-grade bond. Capacity to pay is adequate. Adverse conditions will have more impact on the firm's ability to pay. And low-grade Moody's BA and B, S&P's BB and B considered speculative with respect to capacity to pay, and very low-grade bonds, Moody's C, S&P C and D, highly uncertain repayment and in many cases already in default with principal and interest in arrears. So this type of very low-grade bonds, investors expect that company will not pay coupon on time and principal on time. Thus, required rate on yield to maturity on these bonds is very high than other bonds. There are many different types of bonds. Some coupon bonds include government bonds. These are federal for US, state and municipal bonds. Zero coupon bonds, also known as poor discount bonds, floating rate bonds, and they are discussed. But zero coupon bonds, as its name suggests, they make no coupon payments and they pay face value at the end. The entire yield to maturity comes from the difference between the purchase price and the par value. Cannot sell for more than par value, that's logical. No one will pay higher than par value. Sometimes called zeros, deep discount bonds, or original issue discount bonds. Treasury bills and principal only treasury strips are good examples of zeros. So they are valued as present value of lump sum. We don't have coupon payments here, so that annuity is zero. You only have face value at the end of the period, so finding present value of this face value gives us price of this fund. For example, find the value of 30-year zero coupon bond with 1,000 face value and the yield to maturity of 6%. 0 coupons, we have 1,000 payment at the end of 13th year. So present value of 1,000 at 6% for 30 years gives us price of this fund. This is $174.11. Floating rate bonds, again, as its name suggests, the rate may change from period to year. Coupon rate floats depending on some index value, example, adjustable rate mortgages and inflation-linked treasuries. There is less price risk with floating rate bonds because the coupon payments are adjusted with the current situation. Coupon float, so it is less likely to differ substantially from the yield to maturity. So this flotation is due to market conditions, so it's near to yield to maturity. Coupons may have a collar. The rate cannot go above a specified ceiling or below specified floor. So of course, market rate may change drastically, very sharply due to economic conditions, maybe in crisis, after crisis, during expansion period and others. But coupon rate may have a collar, that's a ceiling, not to go higher. So it's against issuer. Also, if rates go down, sharply go down, there's a floor to protect investors. Other bond types are income bonds, convertible bonds, and put bonds. There are many other types of provisions that can be added to a bond, and many bonds have several provisions. It's important to recognize how these provisions affect required returns. All these provisions, all these conditions are reflected on required rate of investors. Under these conditions, how much investor requires from this bond. And all these provisions are clearly expressed on bond indenture. How bond markets operate? Bond market is an over-the-counter market that transactions with dealers connected electronically, extremely large number of bond issues, but generally low daily volume in single issues. Bond trades are not traded as stocks. Makes getting up-to-date prices difficult, particularly on small company or municipal issues. Treasury securities are an exception. Inflation and interest rates. Some words about inflation because it directly affects yield to maturity. Nominal rate of interest, what is quoted by, let's say, central banks, that's nominal rate. But through years, through the period as time goes, inflation is a fact. So adjusting nominal rate with inflation, we get real rate. Real rate is real of net of inflation. And investors pay attention to real rate. How much will we get? Will we gain net of inflation? Ex-ante nominal rate of return includes our desired real rate of return plus an adjustment for expected inflation. Fischer notes that investors realize inflation reduces purchasing power and insist on higher returns during inflationary times. He says a rise in the rate of inflation causes nominal rate to rise just enough so that the real rate of interest is unaffected. So Fischer Effect defines a relationship between real interest rate, nominal rate, and inflation. He defines real rate as, that's Fischer Effect. Real rate is adjusting nominal rate with inflation minus 1. With this adjustment, we get real rate. Approximation, real rate is nominal rate equals real rate plus inflation. That's approximately equals. We have an example here. If we require 10% real return and we expect inflation to be 8%, what's the nominal rate? Apply our formula. We have real return, putting everything on our formula, we get 18.8%. That is, you should have 18.8% of nominal rate, and if the inflation is 8%, the real rate will be 10%. Again, actually, approximation works here. Nominal rate equals real plus inflation. It's approximately the same. Because the real return and expected inflation are relatively high, there is a significant difference between actual Fischer effect and the approximation. Factors affecting required return on bonds. Default risk premium, that's an important indicator, and this premium information can be seen from ratings of these bonds. So if the default is higher, yield to maturity required rate will be higher. Taxability premium. Remember that municipal versus taxable. Municipal bonds are not tax deductible, but others are taxable. Taxable means that what your yield to maturity we get as an investor, so tax will be deducted on this return, so we will get after tax. That's less than our yield to maturity. As an investor, we may want to adjust that premium on our yield to maturity. And the liquidity premium, bonds that have more frequent trading will generally have lower required returns. So that's if they are high liquid, they will have lower required returns. Anything else that affects the risk of the cash flows to the bondholders will affect the required returns. So in general, bonds are debt instruments, and here we talked about valuation of bonds, pricing of bonds. As in all financial assets, price of a bond is present value of future cash flows. Future cash flows expected on a bond is coupon payments and face value at the end of the period. So present value of all these cash flows at yield to maturity market rate gives us price of a bond. Yield to maturity, this rate is important. It's market rate plus premiums due to risk, default risk, liquidity, and other premiums added on that rate. We get the yield to maturity and finding present value of all these cash flows, we get price of a bond. There are certain Excel functions to find present value of these cash flows or to evaluate these bonds. This is the end of this session. Thank you for watching.